Went to Invercargill to Kmart and yeah, we had money in the bank, you know, and paid all our bills, had these extra money, so away we went. Did our Christmas shopping, but because of that purchase, they have said that we overspend and that we don't qualify for our mortgage top-up.
I decided beforehand to cut out Netflix, the Disney Plus, and, you know, going out for coffees with friends and dinners and takeaways, I just cut all that back. You know that it's pretty hard being 21 and saying to your mates, oh, hey, look, you know, do you mind going for a walk instead?
It was quite invasive, you know, looking back on people's bank statements, asking them about their Uber Eats spend or their reason for Netflix, or we even heard of a case of somebody's counselling bill being questioned.
When consumer credit laws tightened a few years ago, the goal was to protect against dodgy lenders, though many felt the changes went too far.
While well-intentioned, in reality those changes have just loaded costs and delays onto anyone looking to borrow even a small sum of money. And the changes have actually produced some real horror stories, like families being forced to justify their spending on cat food or Netflix.
But at a time when so many are struggling.
More New Zealanders are getting behind on payments. In December, more than 400,000 people fell behind on credit payments, and the number of mortgage accounts past due exceeded 20,000.
Will the government's proposed changes leave New Zealanders even more vulnerable?
I think it's absolutely bizarre that National would get rid of a piece of legislation that protects consumers.
Kia ora, I'm Tom Kitchen, and today on The Detail, how governments have played with consumer finance and credit laws, and how it's affected Kiwis. We're talking about the Credit Contracts and Consumer Finance Act 2003, aka the Triple CFA. Ed McKnight is an economist at Opus Partners, a property investment firm, and he's a co-host of the Property Academy podcast. He's here to take us through what this Triple CFA is supposed to do.
What this law is all about is making sure that people who go to get out a loan, whether that's a mortgage or a personal loan, whatever it happens to be, that they can actually afford it. Because if you're a lender and you're giving somebody some money that they then have to pay back, you're in a bit of a position of power. And so it's all about making sure that people who are lending out money are treating borrowers fairly and making sure that they can actually afford those loans that they give people.
How to protect consumers without overdoing it has been a point of contention. During Labour's time in government, from 2017 to last year, they made quite a few changes to the law. For example,
the government is cracking down on loan sharks and truck shops to protect people from spiralling into debt.
The interest and fees charged by high-cost lenders are to be kept at 100% of the amount borrowed. That means if someone borrows $500, the most they will pay back is $1,000.
The most significant and controversial, though, was in December 2021.
The government is continuing its crackdown on loan sharks, introducing new rules to protect against unaffordable loans. Lenders must already check if a borrower will be able to pay back a loan. But Consumer Affairs Minister David Clark says some lenders are much more careful and diligent than others. He says the new rules will require all lenders to make consistent inquiries about the borrower's needs and objectives.
They'll also need to verify the borrower's income and expenses, so they'll actually need to be a little bit hands-on about that to be satisfied that the repayments are unlikely to put the borrower into significant hardship.
Here's Ed McKnight again.
What ended up happening with those changes in 2021 was the rules became really prescriptive. So it said to all types of lenders, not just payday lenders, but even the banks, and that's really where the issue kind of became, this is how you must assess somebody's mortgage from an income perspective.
The banks are required to go ahead and understand your affordability, so they're going to ask more questions around your expenses, and we need to be able to provide them with details of those costs.
I'll tell you some of the things that you kind of think sound really crazy. So when the banks ended up assessing somebody's mortgage application, even something like you putting $100 a week as savings, that was considered an expense. And if you didn't tell the bank that, yes, I'm willing to stop saving that $100 if I can't get, if I run into a bit of financial trouble, they might count that as an expense. Same with investments. This was what was in the law. Things like gym memberships, tithing or donations to your church. There were a range of things that the government said you now have to consider that or assess that as an ongoing expense if somebody gets a mortgage. And that's where it started to get a little bit silly, I think, and why they made changes quite quickly. Only 4 months after they released the first version, they said, we're going to make some changes.
Yeah, can I just ask you, so there were some of those things that they looked out for, like gym memberships, etc. How did the banks look at that? How did they find out about it?
Well, when you apply for a mortgage, you give 3 months' worth of bank statements. And the big issue was this, that the bank said, look, we are going to have to go and look at everybody's bank statements. It's in the law. That's going to be really troublesome. And so what they did was they started getting a whole heap of software. And so if you put your mortgage application into the ANZ and you give them the 3 months worth of bank statements, they scan those bank statements and they put all of that spending into 17 different buckets. And so then that's how they were saying, hey, you can't afford a mortgage because we've looked at your Kmart spending and it's gone into this sort of bucket, and computer says, no, we're not going to give you the mortgage. The real issue is that I think all mortgage brokers know that when you don't have a mortgage, you have more money, so you spend more money. When you get a mortgage, you have less money, and so you spend less money. But the issue with how the CCCFA was interpreted at that time was it didn't have that level of understanding. So effectively, to get a mortgage, you had to already live as if you had that mortgage before they'd grant it to you. And that's why the national government are saying...
I've heard from banks that an estimated 6 to 7% of applicants who would have otherwise qualified for a mortgage have had to be turned down.
Under the old rules, they would have got a mortgage anyway. Under the new rules, they can't.
Yeah, okay, so quite rapid changes. And you do mention Kmart there. We did hear stories of, people who spent nearly $200 at Kmart not being allowed a mortgage.
Yeah, the issue was all about whether that was considered a one-off or an ongoing purchase. And so that's where the banks, if they saw that you were spending $5 on your coffee every day, or there were regular payments going out to specific vendors, or shops or coffee shops, all of those, that's where they'd start to say, oh, that's an ongoing expense. And so even though you might know once you get your mortgage, once you get your house, you're not going to go out and get coffee every day because you're not going to have as much money. And that's what we do. When we want to buy a house, we have to sometimes cut down a bit on our expenses. There wasn't that understanding at the time because the banks were running your bank statements through software, and it was categorising it in that way. Now, when the rules changed again, of course, only 4 months after the first bout of rules came out, the government said, oh, this is a bit of an issue. We better announce some changes.
Now, this is interesting. The government's had another go at easing up the consumer credit rules, blamed for making it tougher to get a loan, but there's been some debate over whether they've got it right again.
It started to clarify some of those things that I think you and I probably think are a bit silly. So it said, hey, look, banks, you don't have to consider savings or investments as examples of outgoings or spending. You don't have to include that anymore. It also said, look, banks, if you use some benchmarks of what a normal person spends, if it's 2 adults and 2 kids, then you don't actually need to look at the bank statements. Or it also said, banks, if you're going to look at the bank statements, then there's only so much you need to dig into that further. And you can have a conversation with someone who wants to take out the mortgage and say, well, which of these are you going to cut back once you have a mortgage? So it just made it a bit saner.
Yeah. And what did you think of those changes yourself?
Probably around the last year, we've seen far less of those articles talking about people not getting mortgages because of Kmart or coffees or all of those kinds of things. The big issue with the CCCFA, and it was unlucky for the government, is that at that time, that's when interest rates started going up. So back when this legislation or the big changes we're talking about came in, the interest rate was about 3.5% average 1-year rate. Over the next 2 years, it went up to about 6%-ish. And so when interest rates are going up, your mortgage is more expensive, and so the bank doesn't lend you as much money anyway. But we had a double whammy because we had rising interest rates, and then we had the CCCFA to contend with as well. The real issue with this piece of legislation was it wasn't really meant to target banks, right? It was meant to target payday lenders, wipe them out of the market, and the intent of the legislation was correct. We don't want desperate people, getting loans that they can't afford, and it is unethical to prey on those sorts of people. So we should get rid of those payday lenders out of the market. But the issue was that it applied to all lenders, and that included the banks.
After these clarifications were made, a short time after these changes in the law were introduced, did it have an effect on payday lenders and those lenders that the government wanted to get rid of in the first place?
I think it has. So if I give you a personal example, I've got a friend who owned a short-term lending company. I wouldn't describe it as a payday lender. They decided to exit the market because these rules made it a lot tougher. You see, if you run a payday lender business, generally there is a lot of cost in assessing somebody's application, getting it over the line. There have been a number of changes over the last couple of years that when Labor was in power that really made it a lot harder for those types of businesses to operate. And even if you think, before I came on this, I thought, you know what, I'll check out Save My Bacon. You know, that was always the classic one we saw advertised 6 or so years ago.
Save My Bacon, a brighter way to borrow.
They're focusing on bigger loans now. They're not focusing on $100, $200, $300, $400 loans. They're focusing on $1,500 loans plus. So they've changed their business model in response to all of the changes that have come in. And I have seen a reduction in the number of payday lenders operating.
Well, now we've got a new government, don't we? They want to change things. What are they saying?
Well, we're still waiting on a bit of detail. These changes are being spearheaded by Andrew Bailey. He's the Minister of Commerce and Consumer Affairs. And the only detail we've really got was a speech given to the Financial Services Council in January.
Today, I would like to outline some of the fundamental changes that relate to the financial services sector. Another of the changes we will be making is to the Credit Contracts and Consumer Finance Act, or CCCFA. This comes as a particular priority.
The big change that Andrew Bailey is saying he wants to make to the CCCFA is he wants to look at the penalty regime. So if you screw up, Mr. Banker, how much do we charge you? One of the really big issues with Labor's changes was the penalties were pretty severe. Now, I can't remember the exact dollar figure, but individuals at banks could be fined quite a large sum. It was well into the 5 or 6 figures. So if it was deemed that you approved a mortgage to a borrower who couldn't afford it, we're going to fine the bank and we're going to fine you. And that created a culture of risk aversion within the banks. You know, they really tightened up because they didn't want to screw up.
He also talked about these over-prescriptive lending laws that you've talked about as well and wanted to get rid of some of those.
I have seen that he said he wants to change the affordability part of the laws and the rules.
I'm going to remove the prescriptive affordability requirements for lower risk lending. I expect to do this soon as a matter of priority.
I haven't seen much detail about what does that exactly mean, because as we've seen, you can have a good intent and say, yeah, we're going to make it easier for people to borrow money for mortgages if they can afford it. But what does that actually look like? As we've seen, you can have great intent and have the best intentions and want things to be better, but it's not until you dig into the rules that you see, oh, maybe it doesn't quite work out as you first thought. I think the big challenge is going to be what the banks do. So if you put a rule in that says, Mr. Banker, you have to be much more stringent, the bank's going to follow it. If you then say, oh, banker, you can actually be a little bit more relaxed now, well, the banks might say, well, we're not going to throw out this new technology we've just spent millions of dollars buying and implementing into our business. We're not going to loosen up perhaps as much as we're allowed to. We're still going to manage our risk pretty carefully. So there are two parts. One, there's the detail that the minister comes out with. The second is, well, what do the banks actually do?
Well, one of the things that was mentioned in the coalition agreement between National and ACT,
which, to quote, states, we will rewrite the CCCFA to protect vulnerable consumers without unnecessarily limiting access to credit.
Are people's access to credit is limited these days?
I think it probably is under these rules. If you think back to what it was like early 2022, it felt like nobody could get a mortgage, or very, very few people could get a mortgage. And so if they change the rules, I don't think it's going to open the floodgates and any man and his dog, as long as you've got a pulse, you'll be able to get a mortgage. It's not going to be that, but it'll be at the margin, maybe 6 to 7% of borrowers who aren't able to get a mortgage now, perhaps they'll be able to under the new rules.
Is there any worry in your mind over some of these potential changes the new government could make?
Well, I suppose any time you loosen the rules, there are going to be a couple of people who maybe slip through who, really can't afford the mortgage, but it got approved anyway. Now, of course, you'll hope that those people will be kept to a minimum, and that's always going to be a bit of a worry, and you'll see that within any new rule that comes out. And you said in the coalition agreements, they say, hey, we don't want to impede people's access to credit. If you could afford a mortgage, we want you to be able to get a mortgage. But at the same time, they're also saying, but we don't want anybody who can't afford a mortgage to get it, because that would be the wrong thing to do for them.
In Ian Hudson's role as the Salvation Army's Social Policy and Parliamentary Unit Director, he meets lots of people who slip through.
We look to try and put a fence at the top of the cliffs for many of the people that come through our Salvation Army services by advocating for policies that protect or help them flourish.
The Salvation Army has just released its annual State of the Nation report. Part of it looked at financial debt and hardship. I heard that the KiwiSaver withdrawals for hardship surged by 42.4%, and that was the highest ever.
Yes, it is. It's been creeping up over the years. It dipped a little bit after 2021 and 2022. It's gone back up, but it's gone up above where it was before all of that.
Yeah, that's nuts. And other things that I've read in your report about, the number of new personal loans, it's a little bit lower than what it was a decade ago, but you've still got an increase in non-banking lending.
That's right. That's gone up significantly, and that ties to the kind of legislation that we're talking about, Credit Contracts and Consumer Finance Act that's being considered, because often those non-bank lenders don't have the same regulatory rigour on them around checking that people have got the money and, maybe codes of practice about how you go about lining up a loan or arranging for a loan. Those are the areas where we often end up with people who come through our financial mentoring program where they have to try and help them work their way out of debt, and sometimes significant debt.
What do you think's bringing on these trends? Why are we seeing a move towards this?
It's not always easy to pin down one thing. I think the cost of living is one factor. I do think, I know we've heard recently about the government talking about, being, I guess, tougher on beneficiaries who aren't complying with certain requirements.
Cabinet has agreed on the early actions this government will take to support more people into work and break the shackles of welfare dependency that has trapped far too many people on benefits under the previous government. Minister Upston has written to the Ministry of Social Development setting out our government's expectations that all benefit sanctions are applied to people who refuse to comply with their obligations to prepare for and look for work.
But we think that's already happened to some extent. That's why we think we're getting more people. We're getting people referred to us who aren't getting the emergency grants that they might have once got, or other kind of grants for maybe bigger items that they can't afford. That is in part why we think the 40% increase in food parcels, but also why the financial mentors are what they're seeing as people come in more often to things they could have got through maybe a grant from work and income.
So when it comes to the changes that the last government made around people getting into debt and getting credit, how did that affect people? Because they were quite significant changes, and that leaders had to look really closely at finances to decide whether someone should get a loan or not.
Well, I think our financial mentors have spoken very positively of that. That's something that they've been aiming to have for a long time. I guess one of the areas where it's most noticeable is in the car sales area. A car is pretty essential for most people, and so often someone will look to buy a car, so they arrange a loan, but often whether the loan's affordable isn't checked, but even if it is, there seems to be often incentives for car salespeople to have add-on insurance for all sorts of eventualities which carry sometimes excessively high interest rates, and they don't explain it well, and they don't do credit checks on it. And what can happen, and it's just quite distressing when we see this kind of thing happening, is when eventually they can't keep up. That drives them into such a debt that in the end, often the car has to be sold. But when the car's sold, they often don't get the full amount that was paid, and so the family or the individual ends up no car, but with a debt with still interest rates at really unaffordable levels. It becomes a really big hole. One of the things the new legislation was trying to do was to limit, for beneficiaries anyway, that you couldn't take more than 5% of the total income, to pay the debt. The things would be worked out to get it paid in the long run, but you couldn't go beyond that. And that was the bill, the Protecting Judgment Debtors on Main Benefit. It got voted out, which we're pretty disappointed about.
It's shameful and sad to see that this bill won't see the light of day, because on the other side of the house, they just don't care.
You deal with people that are really struggling financially and beneficiaries, but talking about, an everyday Kiwi on a middle income, these laws that Labor have put in have been quite hard for some people to get loans because they might just have a Netflix account or something like that, or have That's few too many coffees. So do you think it's gone too far in that regard, though?
I mean, we've talked to our financial mentors, and they are agreeable to the fact that it's not simple, it's quite complex. And I think what they really want the minister to do is they think he should do nothing initially until he gets a real good grasp of it, because regulations without taking time to think through could have significant consequences, and particularly concerned about our people, obviously. But we do accept that has created some difficulties with people who can pay. But what we're worried about is that they will take away the protections completely from the people that we work with. It's honestly distressing to watch what happens to people.
So, how do we strike the right balance? Ed McKnight just might have the answer. Almost.
The devil will be in the detail. There is always a risk that if you loosen the rules, there may be some bad actors who find clever ways to circumvent the rules, start driving around in a truck and handing out loans to people who can't afford them. We might see that there is a two-tiered system. You might say, well, if you're a registered bank, you have one set of rules. If you're not a registered bank, then you have a different set of rules. And there are about 38 registered banks in New Zealand. So maybe you have a system like that. That sounds quite good. I might have just made that up. I'd like to say that there won't be any more payday lenders, but if you relax the rules, you're probably going to get a few more slip through the cracks.
That's it for today. Thanks to our guests Ed McKnight and Ian Hudson. The Detail is funded through RNZ and New Zealand On Air. This episode was engineered by William Saunders. It was produced by Gwen McClure and Alexia Russell. I'm Tom Kitchen. Ka kite anō.